Hello, and welcome to another episode of Wealth and Toil. My name is Luke Laretive. I'm from Seneca Financial Solutions, and I'm here today with the man, the mystery, the financial planet of the stars, Dylan Pargiter-Green. DPG, how are you?
I'm good, mate. It makes me sound like I'm a tarot card reader for financial advice.
You kind of are.
Financial planet to the stars.
Yeah, it could be your new tagline. Bold well.
Could be.
Planning for the stars.
Planning for the stars. aim for the stars. Hit them.
God, I hate financial planning firms' taglines. Anyway, how's your weekend?
It was good, mate. It was good. I went up to not so sunny Brisbane, see some friends and a couple of clients on Friday as well. So did a work trip and then stayed on for a couple of days, which was lovely. But yeah, looking forward to sharing with the world about how the sun seems to never shine in Brisbane when I'm there. I'm not sure
I lived in Brisbane for 12 months, and I can and we did 2 summers, and I can tell you right now, Brisbane in the monsoon season, I will call it, is not actually that nice a place weather-wise. I could definitely think of better places to be in the warm months of the year.
As someone who, spends time in the southern states, between Hobart and Melbourne, I actually think that there is dead set a winning strategy for spending winters in Queensland and summers in Tasmania.
Well, it's
Melbourne all together.
Claire and I did that last year. Feels like a long time ago. I think it was last year, not the year before.
I think it was last year.
Yeah, but I would be big advocate for that. Big advocate for the mid seasons in Tassie. I'm actually not a fan of Tassie in the peak summer, especially because I go to the farm. It's a bit dry down there, bit dry, a bit dusty. The hay fever gets a bit intense. I like
got to go to the coast, mate.
Get to the coast. But I like the mid seasons on the farm. Whether that's the Easter time, Anzac Day time, or when I just went recently. September, October is also mint down there.
Pretty much all year is what you're saying.
Yeah, pretty much.
Anyway,
I love Tassie. I love Tassie. Anyway, we're not talking about the weather this podcast.
All right, that'll be a wrap. Thanks everyone for listening to Wealth and Weather. So a couple of things we're going to talk about today, specifically around some stocks that we spoke about earlier in the year. It's December. So we thought, okay, well, we started this podcast in sort of February, March. We did a specific stock-based episode. It was the first episode we did with Professor Dr. Lecturer Ben Richards, who is unfortunately can't join us today because he's doing some actual work. But no, we're going to review 3 of the sort of key companies that we looked at the start of the year, and then also another one that we've it's been on the radar. It's something that we use for some clients. You've spoken about it, but it's in the news at the moment for one of the companies
start there
that they purchased. So the company is GQG, and they're listed on the exchange. They've been actually a really strong winner, and we think that my view is that they're pretty wonderful investors. They have been hit with a bit of a curveball in one of their largest holdings, though.
Correct. So let's get 2 things, one thing straight here, and separate GQG, the funds management business, and GQG, the managed funds /funds, plural. Like Seneca, you can invest in our products, the funds that we run, the SMAs that we run. GQG, you can invest in their GQG Global Equity Strategy. You can invest in GQG Emerging Market Strategy. That is not buying shares in the company. So, in the same way that by investing with us, you're not buying shares in Seneca, the business of running those funds, collecting the fees. When you buy shares in GQG on the exchange, you're not buying a managed fund. You're buying shares in the management company. So it's really important to delineate between those 2 different things. GQG as a business operating managed funds is quite a simple. I mean, what we do, what they do, they do it at a much bigger scale than what I do it at. It's a very simple business. You pay exceptionally talented people, largely quite well, and to do the job. And once you've covered those running costs, every incremental investor in the fund, every incremental dollar in the fund is quite profitable. And as a result, when you've built a large fund management business, as GQG have done, they generate significant free cash flow every year, and they're able to pay large amounts. Historically, it's been sort of in the order of 70% of their earnings or their profits back to shareholders via dividends. So the stock's always traded on a relatively high dividend yield. I think it's on about 8.5% at the moment. So that's the business. Now, the issue is that one of the holdings they're a global fund manager. They invest in global shares, as I said, developed market and all over the world, and then specialising in emerging markets in the other product. Both of those products are invested with Adani Group. They're a large Indian conglomerate. Think about them as, imagine if Indian West Farmers, I suppose is probably, but they do port, they do power, they do infrastructure, they do construction, they do lots of different things. So what's they've been accused, that company Adani has been accused by the US government as paying bribes and sort of having some corruption issues. As GQG shareholders, from my perspective, not such a big deal. While the market may disagree with me, they think that they've got huge reputational risk here, and that they're going to have significant sustained period of outflows now. I don't agree with those sentiments, and the reason I don't agree is I think that whilst people are ethical, they are more greedy. And if we look at both the fund's performance in November, during when this sort of all broke out on the 21st of November, both funds have ended the month ahead of benchmark, and emerging markets is slightly below peer group, but not by any. We're talking less than 1%, and global strategy is still well ahead, or vice versa. I can't remember. I had a look at the numbers last night, but the net is they're there or thereabouts, doing what they always do, performing quite well relative to the peer group and relative to the benchmark. They both got exception. Both those products have exceptional track records, and they have a very sustainable investment process. So my personal view is asset allocators, people who talk to clients, allocating client money to fund managers like Dill, like me, would be very reluctant, I think, to be pulling money, selling down GQG on the back of these issues with Adani, when in reality it's actually not impacting the performance of the portfolio in a material or interesting kind of way. So, not saying that it won't in the future. It might. Maybe there's something out there I don't know about. But I would like to think that the markets here is overreacted, and the share price is down from, say, I'm just thumb sucking here, $2.50 to $2, which in our view looks like great value. We bought a few shares in GQG in the small companies fund at Seneca. We think it's a decent sort of price and valuation for what the business is at the moment. And we haven't seen these prices for a while. So that's kind of our wrap on GQG. I don't think anyone investing in the fund needs to be worried. You'll be happy with the November numbers, and even taking into the Adani stuff into account. From a head stock perspective, from a company perspective, you've seen the founder buy a shitload of shares. You've seen the company instill a $150 million buyback. They're signaling to the market that the shares are undervalued, and I don't think.
Is this a sustained way
or no, GQG?
GQG, yeah.
And I don't think I think there probably is some sort of problem for Adani. What I'm trying to say though is that if you took an 8% position from our two funds that we were really heavy in, and it went down 30%, that's not good. But it's not going to ruin my business. You know what I mean? Like
that's why we build diversified portfioles. And yes, you know what? Adani was a massive bet in those two funds. But
8%'s not massive, bro. Like 8% by fund manager standards is massive. 8% by like hedge fund standards is fucking nothing. Like, if you want to invest with a Caledonia or a Bronte Capital or one of those kind of big hedge fund guys who want to compete on a global scale, who, by the way, don't compete on the global scale and have got terrible numbers. But by the by, they're buying, 25 or 30%. Well, it's just a fact, right? 25 or 30% in single stocks. So and good luck to them. They'll probably make a heap of money for people down the road. I don't know, but all I'm trying to say is that 8% positions not like super high conviction in the grand scheme of things, and it's certainly not going to break, in my opinion, a GQG as a funds management business.
Yeah,
and it hasn't impacted returns for investors that much.
I think it's pretty fascinating that you seen a 20% drop off in the stock price. There has been some large institutional investors pull quite a bit of money out, but from funds. But I wouldn't say that that's a trend that you'd expect to continue, given actually what the effect on performance has been is relatively.
And GQG is not like an ESG focused investor, so it's not like these guys are all of a sudden they've copped all this money from ESG focused investors, and now they're exposed to ESG risk. I don't, and they're going to have outflows as a result. I don't think that is.
Ironically, they do have a fairly good ESG charter.
But whatever.
As a business.
You know what I think about ESG. It's all for guys.
Yeah,
anyway. Marketing rubbish. So anyway, look, I think that that's GQG deal. That's the rundown.
Yeah. Well, look, it's interesting. It's a we've used them for a number of years as fund managers. We really like their process and their people. Like that they do things differently to a lot of the other managers. Like if you look at their large cap fund, it genuinely stands out amongst peers as having things other than just the Magnificent Seven in there, which is really good. But of course, there's other good options as well, and it's all part of building out a diversified portfolio of global managers. So yeah. Anyway, I thought it was interesting just because we've spoken about it a few times.
Yeah, I can't see our IC taking any money off GQG this month. That's my personal opinion. We'll discuss it obviously, but as a business, but I can't imagine that anyone will be wanting to chirp about that too much.
Yeah, no, absolutely. All right, so we've got then three holdings. Or three stocks that we spoke about earlier in the year. The episode was on the 1st of May, and we were talking about falling rates and some opportunities for small caps. So this probably sounds like a broken record because you and I talk about small caps on this. It is an area that you specialize in somewhat.
What else am I going to talk about? Like small cap, large cap.
Okay.
I'm pretty boring.
Well, anyway. You are boring, but somehow we somehow we get one new listener every month. So, but no, we spoke about three stocks, and as I said, Ben can't join us, which is a shame. But it's a really good point. Start of December to review these, and yeah.
What have you got for me? What have you got for me?
So there was three stocks that I wanted to talk about. We looked at RPM Global.
Well,
we looked at spoilers. We looked at Monash IVF.
Yeah, it's about average.
And we looked at GDC, Global Data Centers. So
that's 2 out of 3 ain't bad.
All right. Well, let's start with the average news. So Monash IVF, right? It's a great story. It's a one of the only listed IVF companies in Australia remaining that's not part of a conglomerate. Is that right?
Yep. Yeah. I mean, everything else has pretty much been bought by private equity, one way, shape, or form. Look, it's still cheap. It's probably down.
It's cheap.
Down 10 or 15% since we talked about it. We still own it. We still like it. We still think it's a takeover target. In fact, Benny just put an article up on Livewire yesterday that I think covers, it's like 8 takeover targets for 2025, and Monash IVF's in there. The main issue there that's been dragging is, with the cost of living crisis and I suppose what's been going on in the economy, IVF cycles and growth in the industry has been pretty lackluster for the last 12, 18 months. So the macro has not been good for them. They're still outperforming the industry and doing quite well, but the industry's going pretty average. So the stock price has kind of dwindled. It's probably starting to pick up now a little bit when we look at the data. The Medicare data that just come out was in November was pretty decent. But it's not going to shoot the lights out tomorrow. But we think that in this market, falling rates environment, equity valuations going up, global peers trading on like double the valuation. To us, Monash IVF still looks pretty good. So that's an interesting one. Little small cap, healthcare small cap. If you are an ESG investor, I think that's a pretty good way to play it. But also, it's a good business. So there's lots of structural tailwinds about why having kids later in life and greater infertility issues and blah 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 blah, all that sort of stuff. So there's lots of reasons why that will be a good long-term winner in our view, and why private equity would want to own it. And I think at these valuations, I don't see why they haven't bought it already, but I reckon that'll happen pretty soon, personally.
Yeah, interesting. So private equity rather than an existing company that wants to sort of global, or a global company that might want to dip their toe into Australia.
Maybe, but look, I would think private equity is the natural owner.
Yeah. Okay.
Natural owner there. It's the kind of business they like, and because they can just do rollout.
And it's a long-term hold for them. There's no pressure on immediate cash flow.
Structurally supported, blah, 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 blah.
Yeah.
So, look, I think that's for them. What's the other one? RPM.
All right, so RPM then. RPM. Remind us all.
So they're like a mining software business. They've got a few different softwares.
That's right.
Yeah, like mining engineers out there will know like Rungi, but there's like a bunch of other ones that probably are maybe less brand aware to the average punter. But look, really good business, growing steadily, still not expensive. So I think what did I say, 30%, 25-30% since we talked about it originally.
29% as at this morning from the 1st of May.
Very good. Been a top performer for our fund. It's one of our bigger holdings, and we still like it. Again, it's set up to be taken over. Really, this should be inside a bigger.
So who's going to buy this one? Like BHP?
This will be like a trade buy. I don't think it's not really the kind of thing that a mining company would want to do. It's more so like a trade buy, a bigger company, bigger software business who want to get exposure to these clients and maybe able to cross sell other stuff into them. So, it could be anyone from like a consulting company, like an Accenture type sort of company, or it might just be another software business that wants to roll up and increase their product suite. Because at the end of the day, that's kind of the game in SaaS. The game in SaaS is to sell, is to put your clients in a package, in a bundle. Scott Galloway refers to this as a recurring revenue bundle, or a rundle, he calls it. But essentially, you want to sell multiple products from one sort of entity and have a one-on-one customer relationship, but you essentially buy lots of things off the same people, and they service you, and you get benefits from buying all the stuff together, and they all talk to each other nicely, and blah blah blah. So think about someone who would fit in there. We've got a few ideas. Maybe I don't want to necessarily talk about them all the time, but again, Benny's article kind of lays that out pretty. It's also in that article, so you can also go and suss that.
We'll put that article in the show notes.
That's an easy one.
We'll send it through. But common thing in that, and it's also talked about in that article. For anyone that's watching this, I have a feature on my laptop where animations come up, and just sometimes accidentally they come up. So we just had some balloons fly across the screen, which was
very
awesome.
professional. Very
professional. But both of those are takeover targets, you said. So why is then one, if the outcome or the catalyst that we're trying to search for here is this future point of where they're going to be bought by another business, and that's going to lead to maybe either a one-off boost or a continuous boost in the share price. Why is one done 30% above and the other one's done 15% below?
Pretty much. I mean, share prices follow earnings still. So, if your earnings are going up, typically your share price is going to go up. Now,
Yep.
there are the odd occasion where your earnings are going up and your share price is going down. And sometimes they're opportunities and sometimes they're value traps. But I think for RPM, I mean, they've continued to deliver double-digit growth, top line, bottom line, and
so why wouldn't they just? Why wouldn't they? Like if they're
they will.
growing,
I mean, this is like where everyone goes wrong.
Yeah.
Everyone tries to find stocks that are going to get taken over. The reality is you want to think like the things that companies want to buy are the same things that investors want to buy. So what your job really is just to find value. And I mean, I could be sitting here as an investor, like I am. I could be sitting employed by a company that's looking to acquire a software business or an IVF business, and I'd be making the same argument instead of making it publicly to clients and trying to attract people to come and invest in our products because we know what we're talking about. I'd just be making that argument to my boss and saying, hey, head of strategy or CFO or COO or CEO or board or whatever, guys, I'm the business development team. We've been through every available acquisition in the market. We've got X million dollars of dry powder here and a debt facility of blah, 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 blah. If we bought this business, bolted it in here, we'd be able to get these synergies and we'd be able to, we think the revenues can grow like this, even in a conservative environment. These are the risks associated with the transaction today. These are the risks associated with this transaction in the future. I'd put together a fancy slide deck and present that at a meeting of some description. That is what happens when you're in a BD team working inside a big business. And so, Ben and I had a conversation this morning about a different topic, which we can touch on if you want to, about De Grey. But my perspective, the way that I think about stuff is I take myself out of fund manager shoes and I put myself back into a BD team at the company, at a company that works in that industry, in that sector. And I say, well, what can I do? Would I do this? Would I do that? What would I recommend? And typically I find that to be a really, useful way to think about corporate activity and takeovers, is because you can kind of put yourself in the shoes of the people who would be making those decisions, and you can think about yourself, okay, I've got a $300,000 a year salary here on the line. I want to be conservative. I need it to be data driven. I can't be making speculative bets with balance sheet money, company balance sheet. My boss is going to have to answer to shareholders. My boss is going to have to talk about this at the AGM. So how can I what would I wait for? Where would I take risk? Where wouldn't I take risk? It's just a really nice lens to think about investing through. It doesn't always work because there's no catalyst. Sometimes these businesses know all this stuff, but there's no reason they need to buy it. And I think that's probably an RPM situation, is that the people who are looking at this have already looked at it. They know it backwards. The question is
it's not sexy.
Well, it is sexy. It's actually a really sexy business. I mean, if you talk about, what's sexy to you? Well, sexy to me is recurring revenue, high incremental margin, and monogamous relationship with a high value customer. If that to me is the sexiest business model you can sort of put together in 3 dot points. Well, RPM would fit into that bucket. So, look, by the by, it is. We think they'll both go. I think Monash IVF is probably before RPM, but who knows? I mean, that's just me making a guess. So that's they're the first two from May.
All right, there you go. Oh, there's one more, and it's the best. So save the best for last, or the best performer of the 3. But GDC. So I really liked this when you talked about it, or when Ben talked about it, and it's had a big bump late May, so it was good timing, and then it's had a pretty good trajectory since then as well. So global data centers, the 1% stake in AirTrunk was obviously a good.
That's the main deal, right? That transacted. Money's been returned to shareholders. Or money has been, or it's about to be returned to shareholders. Really good outcome. I think. We made a lot of money this year in that, and it was our biggest holding, I think, when at the time. So stocks up. Stocks up total. I think total return 57% since May, which is pretty naughty.
Yeah, absolutely.
And yeah, look, I mean, there's not a lot to say there. That business is now, there's nothing left there for that. There's no real assets left in that business.
So that's my question about this one. So 57% May to December. That's awesome. What's there now? Is it an exit?
Yeah, look, from our perspective, we've sold it. We've sold it. We're out. We think David Jewell and the team there did an amazing job, and he did exactly what they said they were going to do, exactly what they were incentivized to do, and exactly in the interests of shareholders. So, that sort of alignment is probably rarer than people think. And look, I've always been really impressed by David. And I know that Ben would say the same thing. They'll probably do something else in the near future with that vehicle, maybe with a different vehicle. I don't know. But a listed vehicle is always worth something. You can always backdoor some assets into it. But they've done what they said they're going to do, and essentially giving the money back to shareholders. So, kudos to them. Stoked to be a shareholder for that period of time. And if they ever did anything in the future, I'd be pretty surprised if we weren't supportive of it and didn't want to get back in business with them again. So
that's an interesting thing, and like we talk about this a lot. Like some companies, like what we're talking about, RPM, there's sort of steady long-term growth. Some have a catalyst, like a purchase, or in this sense, own
capital return.
Stocks. Yeah, capital return, right? But what stops you then from? Is it just the fact that you don't know what they're going to do next? Like, are they still making money? Like, because it's not just like, hey, here's the money. We're just going to sit and be a business now, and hopefully, I don't know.
There's still some residual value. I mean, there's still residual value in the business, but essentially it's wound up now, right? It's all done. So they'll return all the value to shareholders and delist. That's it. Like, nothing else.
That's it. They're done.
Done. Dish is done. Go have a look at how much money they made. It's actually obscene. The money they made is obscene. So, but look, I think, that's sort of, a good example of, we've written about it a lot. People can go and read back about our thesis. It's on Livewire. It's on this podcast. It's on, Rask and other places where, Ausbiz, where Ben and I are always doing content. So if you want to go back and do it, I mean, the article I'd point people to is we did a review of small cap fund returns for Livewire not that long ago. I think it's under Ben's profile. So just go and have a look for that on Livewire. It's there, and how we found GDC and how we were able to identify it is there. In fact, it's on Equity Mates. I talked about it just recently with the boys on the latest Equity Mates we did. So if people want to go listen to that too. Dill, I got one more I want to brag about.
Oh, here we go. It's one.
Okay, so last week,
2 weeks ago.
2 weeks ago, you asked me very obnoxiously to bring 2 stocks that people should invest in for 2 months.
Yeah.
One of those stocks, and you gave me a hard time about giving you a mining stock, was De Grey Mining, and I said they were going to get a permit. Well, someone also thought they were going to get a permit and decided Northern Star decided that they better lob a takeover bid before they get the permit, and it goes up, which is smart from Northern Star.
Very smart.
So Northern Star lobbed a bid. The stock was trading at $1.40 or thereabouts. The bid is equivalent to $2 a share or more, depending on it's a script bid, so it's oscillating around a bit, but it's a decent premium.
It's
decent 2 week, decent
40%.
Yeah, in 2 weeks. So I just need to just put the flag in the ground there and wave it around a bit. So that's that is some of the best work you'll see. That's some of the best stuff you'll sort of see.
Very good. I won't ask you what the other one is because I can't remember, but it certainly did better than the cash
Vulcan
strategy.
Vulcan over the last 2 weeks. But for a balanced view, Vulcan last week did. So the week we talked about it, it went from 6.20 open, closed the week at $7, was up 12%. The following week, it opened at 7.30 and closed at 7.10. So it's still up another 1.2% for the week. and then this week it's actually gone down. In the last couple of days, it's down actually 9%. It's back to 645. So there or thereabouts.
Volatile.
It is very volatile. I don't know what happened. It went on a run. It went on a real run for a bit there, but nothing. I think there's more news flow to come. 6.45 to me. We're still up 25 cents a share on a $6.20 buy price if you wanted to use the start of that week.
For a 2 month, on a 2 month strategy.
Yeah, so that's not too bad. So
it's good. 25 cents.
And I mean, you could have sold it. I mean, last week it was trading at 8. It went up to 8.48 at one point.
Yeah,
so you could have got out for
8.48.
You could have got out for a 30% gain at some stage in the last 2 weeks. So, look, I'm not saying I'm always right, but last 2 weeks I've been pretty right. So look, that's it.
Well done. No, thanks.
There's our little review.
You're pretty good. You're pretty good at talking about those. I wanted to grill you a little bit. I think next week might be our last for the year. Am I right?
I think it might have to be.
You sound tired, mate.
Yeah, I mean, I'm getting a bit jack of doing content, to be honest. But this time of year, that normally happens. So I think we'll do one more for the year, and then I might get you to splice up some clips or something for the punters over Christmas.
Just mad splicing.
Yeah. Anyway, we'll talk about that later. But mate, look, enjoyed this one today. Nice for me to do a victory lap.
Very good. Very good, mate. Very good.
But will I see you in the city this week?
No, you won't.
Are you in Tasmania for the rest of the year?
I'm Melbourne next week, so I'll probably see you then.
I'll see you next week.
Very good, mate. All right, have a good
guys.
one.
Thank you so much.
See ya. Bye.
Bye.